Welcome to the Velocity channel.
Today, we are diving into the big stuff. Gold hitting record highs, Japan's bond market flashing warning signs, and whether it is time to trim your Bitcoin or short the market. We will break down what is happening with Nvidia, the yen carry trade, and why even gold miners can fall during a crash. Just a quick heads up, this podcast is for educational and entertainment purposes only. It is not financial advice, and we are not sponsored. Always do your own research. So grab your charts, stay curious, and let us get into it.
What? You have any idea what you just did?
Come on, we just made the deal of our lifetimes. We should celebrate.
You just bet against the American economy.
Fuck yeah. Fuck yeah.
It means if we're right, people lose homes, people lose jobs, people lose retirement savings, people lose pensions. You know what I hate about fucking banking? It reduces people to numbers. Here's a number. Every 1% unemployment goes up, 40,000 people die. Did you know that?
No.
Did you know that?
No, I didn't know that.
Just don't fucking dance.
Hey everyone, welcome back to the channel. Just a quick reminder. This podcast is for educational and entertainment purposes only. It's not financial advice, and we're not sponsored by any company or product. Always do your own research before making investment decisions. Today we're diving into some big themes. Gold hitting record highs, Japan's bond market shaking up global liquidity, and whether it's time to trim your Bitcoin or AI stocks. And joining me is our brilliant guest Maya, who's going to help us unpack it all in plain English. Let's start with gold. Gold price high in every currencies. For example, it's now over $4,000 American and over $6,000 Australian. That's massive. What's driving this surge?
As an ex-Wall Street microeconomist, it's a mix of fear and strategy. Central banks are buying gold aggressively, especially China and Russia. Investors are hedging against inflation, currency risk, and geopolitical shocks. Gold is acting like a global insurance policy.
Japan's 10 years bond yield just hit 1.807%, highest in over a decade. And USD Fei Japanese yen is at 157.31. That's extreme. Why does that matter?
It's testing intervention levels. If Japan steps in to strengthen the yen, it could trigger a wave of selling across global assets, because Japan used to be the world's cheap money engine. When their yields rise, it threatens the carry trade, where investors borrow yen to buy riskier assets. If that unwinds, global markets could get volatile fast.
Here is what I've noticed. When markets crash, even gold and gold stocks fall. Is anything actually safe?
Great observation. During margin calls, which means a broker's demand for an investor to deposit more money or securities into a margin account because the account's equity has dropped below the required level, and if there is no money added, traders have to sell everything, even gold, to raise cash. But physical gold, cash, and unleveraged assets tend to recover faster. Safety depends on liquidity and time horizon.
Right, let's talk tech. Nvidia just posted record earnings. $57 billion revenue, mostly from AI chips. But some say this increases bubble risk. What's your take?
It's true. Nvidia's results are brilliant, but they're also fueling speculation. Michael Burry, the famous hedge fund manager, bet against Nvidia with $187 million in put options. So far, he's losing, but if AI spending slows or geopolitics flare up, he might be right.
What about Bitcoin? Bitcoin's around $92,000. If people sitting on gains, should they trim? Same question for AI ETFs and AI shares. If people are sitting on gains, time to trim.
Well, yes, tactically. Nvidia, Apple, and Amazon are stretched. Trimming 10 to 25% lets you lock in gains and rotate into safer assets like gold or gold miners or inverse ETFs like SNS on Nasdaq 100 in Australia or PSQ on Nasdaq 100. But remember, taking short positions involves a higher level of risk to an investment than a long position. You should be very careful that inverse ETFs are not suited for everyone due to high risks. Only professional investors should use these products.
Is gold mines better to invest or gold ETFs? Gold mines also give you dividends.
Gold and gold ETFs are great for pure gold exposures. Low cost, low volatility. But it doesn't pay dividends. Gold mines like Evolution Mining, EVN, or NST, the biggest and most profitable gold mine in Australia, or Newmont, NAM. In Australia and United States, the biggest gold mine offer income and leverage to rising gold prices. If you want growth and yield, miners win. If you want simplicity and safety, gold and gold ETFs are ideals.
So what's the big takeaway for our audience?
Well, invest yourself first. Watch Velocity Connect channel. I will bet you that you will learn a lot. Trim overheated positions, stay diversified, and watch macro signals like bond yields, gold, and USD and Japanese yen. Use tactical hedges, hold quality assets, and think in time frames. Long-term optimism is smart, but short-term caution is strategic.
Thanks for tuning in. If you found this helpful, hit like, subscribe, and drop a comment with your favorite gold or tech play. We'll be back next time with more market insights and portfolio tactics.